You've heard it before. Geneva, broker bank, home the office, whatever the case is, great pricing. If you're thinking about moving your license, you might want to talk with these guys. I've got a pretty significant head cold right now. The fact that I'm sharing this means I really care. Like this banner right over there. Okay, so we're going to try to explain something that we think is very important to the real estate industry, but it's hard to put in words. So I want you to try to follow us on this thing, okay? Here's our thoughts.
Right now, there's a move within agencies that would restrict capital, which in turn would result in higher interest rates for your borrowers. Okay, we gotcha? Keep listening.
Okay, first let's look at the case with PHH and the CFPB. In an oversimplification, PHH got busted by the CFPB for making those they gave loans to buy their mortgage insurance. They steered them, that's the claim. If someone didn't buy PHH's insurance, they didn't get the loan. Again, that's what's being claimed. The allegation is that this is a RESPA violation. The case is still going on, and we really won't know more about this till sometime in the fall next year. PHH is fighting back. By the way, this is a case where the fine was raised by the CFPB by over $100 million. PHH was involved with a captive insurance. Got it?
Okay, captive insurance. Hang with us. We're going to shift gears just a little bit. A year ago, the Urban Institute put out a paper that states, the FHLB, or the Federal Home Loan Bank, and Fannie and Freddie were going to propose rulemaking that would significantly revise the requirements by which financial institutions can become and maintain their membership in the FHLB. The proposed rule would alter several regulatory practices. One such thing is they would change the definition of an insurer, which would exclude captive insurance, like PHH's insurance, for which they find themselves in a legal battle with the CFPB.
Membership to the FHLB, the Federal Home Loan Bank system, is an important means of liquidity for the mortgage market. Changing membership to exclude means fewer groups that work to bring money to the mortgage market would have access to these guys' funds. As we've said before, the FHLB has $1 trillion out in loans right now. They're big.
One group that would be excluded is real estate investment trusts. Mortgage real estate investment trusts are groups that invest and buy mortgage debt.
Now, David Stevens of the MBA says, unlike the GSEs, mortgage REITs, the real estate investment trusts, can originate and acquire non-qualified mortgage loans, providing many families with accessible, sustainable financing alternatives that would otherwise be unavailable or unaffordable. And he goes on to say that regulation implemented since the crisis, coupled with new regulation on the horizon, has driven up the cost of obtaining this funding. These factors increase the cost consumers must pay for mortgages in terms of both fee and interest rates.
Okay, so to be clear, the reason that these mortgage REITs would be excluded from access to that FHLB money is because they participate in captive insurance like PHH.
So why would we want to do this? Changing the term of insurance to exclude captive, which would alienate the mortgage REITs, or in the case of the CFPB, to sue using a RESPA violation in the attack on captive insurance, as done with PHH.
To us, it doesn't seem to make a lot of sense. So the rule, which the Urban Institute said would come as a notice of proposed rulemaking, is here. The FHFA, which oversees Fannie and Freddie, has come out and said membership to the FHLB, which gives access to their funds, will define an insurance company to now exclude captive insurance.
So the GSEs, no captive. The CFPB via RESPA with PHH seems to be telling the industry captive insurance is bad. So from a pragmatic, legal, and punitive point of view, what should the industry who uses captive insurance do?
What we seem to be hearing is, get rid of it, run away from it, don't use captive insurance.
That's right. That's what we're hearing over here very loudly. Don't use captives, even though they are a critical source of debt capital for the mortgage market. That helps keep rates and fees down for your consumers, and over the course of the past 2 decades have helped facilitate and play a pivotal role in housing.
Okay, so it seems counterproductive. Why in the world would they do this?
Well, we've heard legal arguments, but I mean, let's face it, legal arguments can prove that an elephant can hang off a cliff with its tail tied to a daisy. I'm thinking, I don't know, maybe money?
Well, according to Money Crashers, while a large cap stock rarely pays a dividend yield above 5%, it's not uncommon for REITs to pay dividend yields of 10% or higher. In 2011, some REITs were paying dividends of over 15%, and for the first half of 2012, many of those companies' stocks also rose over 10%.
Lots of money on the table for both PHH and clearly lots of money on the table for REITs. So is this more a narrative that Wall Street and banks are simply bad? One that we've heard as recently as the last debate? Or what we felt through malicious enforcement, rule writing, and regulation? The thought of, they're making too much money, therefore they must be bad, I mean, I don't know. It makes you kind of wonder, doesn't it?
Point is, the concept of captive insurance has been around literally for hundreds of years. It's been used effectively to help bring liquidity and affordability to the mortgage market for decades, and it appears to be on the way out.
And the reason we bring this up is, first of all, everybody should know what's going on and its broad sweeping effect it could have on the industry.
Right.
And more importantly, once you know, then maybe you can share this with others and maybe start to influence some of those that are making these rules to change this.
Yeah, absolutely. I mean, and just, I know we've kind of gone long on this show, but essentially, you get your mortgage done, there needs to be PMI. The PMI kind of just comes part of the deal from the lender. I mean, the borrower doesn't really go shopping for mortgage insurance by any means. So essentially, this could make it to where they have to go shopping now individually as consumers for their individual mortgage insurance, would just be chaotic. It'd be ridiculous. So let us know your thoughts down below. Forward and share. Subscribe from your upper right-hand corner. Catch you later here. Have a great weekend from the National Real Estate Post.
Off to get some NyQuil. Dayquil, NyQuil.
Bye.
Main bean it. Main vein it.
Jim Beam it.
Beam it. Bye.